Back to All Things Money. This is David Blain, and during this segment we're going to answer some of our viewers and listeners' email and questions that they sent in. But before we do, in our recap of the bull market and the stocks, I neglected to mention anything about our clients and viewers out there who are investing for income and yield. And so I just wanted to touch real briefly on some things. We're continuing to emphasize what we call the spread product. In bond investing, you have treasuries, and then anything that adds risk above treasuries is called a spread product, such as corporate bonds or high yield bonds or things like that. And so we're currently emphasizing the spread product, taking the extra yield afforded by high yield bonds and corporate bonds as opposed to treasuries. We're severely underweighted treasuries right now and emphasizing the corporate bonds. There's a couple other things that right now we have a environment with moderate profits and low inflation. That's sort of the economic outlook right now, is we have moderate profits and low inflation. And so what we did was we took a look at, in this economic environment, for people that are looking for income and yield and things like that, what are the things that have been most favorable to produce that? Number one, interesting, was real estate investment trusts. The real estate market in general is still having a lot of problems, but real estate investment trusts have been on a tremendous run, both in price appreciation as well as yield. You can still pick up a good 5, 6, 7% yield on real estate investment trusts. The second thing that we recommend is high yield corporates. The risk of default has lessened significantly since the bear market, and once again on high yield corporate bonds you can pick up a good 7-8% yield. We're also looking at commercial mortgage-backed securities as well as investment grade corporate bonds. Those are our four favorite things for yields. That's real estate investment trusts, high yield corporate bonds, commercial mortgage-backed securities, and corporate bonds. So that's for people looking for some yield and income. That's what we're emphasizing right now. So let's get to some of our viewers' email. Maggie writes in, I've seen the name renminbi used to describe the Chinese currency. I thought the Chinese money was called the yuan. What's the difference? That's a great question, and it's a question that I had myself. As the Chinese economy becomes a more prominent part of the global economy, these are things that we should understand. And simply put, renminbi translates into the people's currency, refers to the official currency of China, where the yuan is the actual measure of the currency. So for example, if you were going to buy a new car in Beijing, you would see it priced in 10,000 yuan. That's how it would be priced. It's similar to the British pound sterling, which sterling was the original currency for England, and of course the pound is the unit of measure. And so you probably hear a lot about the Chinese currency, and of course the U.S. is accusing them of keeping it artificially low, and the Chinese government keeping their currency pegged to the U.S. dollar. And so you hear a lot of these terms bandied about in the press today. So we thought that was a very timely question. The next question comes from a young investor stationed at Cherry Point who's just getting started investing in mutual funds. And he wants to know, what's the difference between an open-ended and a closed-ended mutual fund? And that's a great question. An open-ended mutual fund, which is a fund that most people are familiar with, it's what probably 95% of the funds are, means that there is an unlimited number of shares available to buy. If you have $1,000 and you want to invest in an open-ended mutual fund, you place your order and you will get $1,000 worth of that fund. The fund manager receives inflows every day, and people take their money out, and he takes that extra money and he invests it in something. And so you receive a proportionate share of whatever that fund owns. A closed-end fund, however, is much different. A closed-end fund trades more like a stock. There's a set number of shares, say 10,000 shares of a closed-end fund that are set out in the beginning, and then those shares are traded on the exchange. And so its price will vary much more with supply and demand because there's a fixed number of shares. And so if you have a lot of closed-end funds are in the fixed income space. And so if you have a closed-end fixed income fund and there's a lot of demand for it, the price can rise above the value of the actual securities that are in the fund. With an open-ended mutual fund, the price of the fund is simply the weighted average of all the securities that the fund owns. So if it owns, a share of Coke and a share of GE, and a share of ExxonMobil, the price of the fund will simply be an average of those shares. Whereas a closed-end fund, even if it owned those same three companies, the price of the closed-end fund could be much lower or much higher than the sum of the companies within the fund. And so one is not necessarily better than the other, but it's very important, especially with a closed-end fund, if you're going to buy one, that you understand the concept of premium or discount to net asset value. You don't necessarily want to buy a fund when it's trading at a very high premium to net asset value. That simply means that you're paying more than the securities that the fund owns. So you want to be careful with that. One other thing that we saw in the news, we've talked about a little bit before, is we had people writing and asking about the estate tax. And believe it or not, in the year 2010, currently there is no estate tax. The estate tax rate is in fact zero. There's been some talk about going back and making it retroactive to tax people that passed away in 2010 already. At this point in the year, with the financial reform on the legislative agenda, as well as some other things, I just don't know that that's going to happen this year. There's a lot of legal professors and great legal minds that, in fact, don't think that would be constitutional to go back and resurrect a tax on a person that's already dead at the time at which, although I wouldn't put it past Congress to do that. There's not. I don't know how well that would fly. So we have the whole estate tax issue that is still out there. Of course, at the end of 2010, if they do nothing, it is scheduled to revert back to the old rate of a $1 million exemption, which would capture a lot of people. They're also talking about eliminating some favorable estate planning strategies. So maybe next week when we have a little bit more time, we'll get into some more of those issues. But for now, the global bull market is still intact, and we hope that you'll join us next week right here on All Things Money. This is David Blain. Have a good night.
The proceeding was a paid program. The opinions expressed are not necessarily those of WNBU and Inner Banks Media.